Hello, everyone, and welcome to today's webinar, where we are going to be looking at the markets through the prism of volume price analysis and other aspects as well. But before we start, may I just draw your attention to the disclaimer that I know you can see on your screen. As you know, trading and investing can be a risky business, so please don't ever think of using money that you cannot afford to lose. Just take that down. When we were thinking of putting this webinar together, David and I thought, well, shall we divide it into market specific, shall we start with a bit of Forex and a bit of this and a bit of that? But actually, when we thought about it, given the state of the market at the moment and sort of geopolitical events, etc., we're really at a point in the markets when, regardless of what you trade, whether as a day trader or a slightly longer term trader or even as an investor, you really have to know what the other elements of the market are doing. And just as a recap, the capital markets are the Forex market, the bond market, the commodity market, and obviously the equity market. So even if you are just in equities, you really have to know what the bond market is doing. If you're in equities of companies that maybe earn most of their revenue from abroad, then the exchange rate is going to be quite important to you. And if you are a Forex trader, you will know, especially if you have taken our program, that we look at the Forex market through what we call related markets, relational analysis, cross-market analysis. And as I say, and it doesn't really matter whether you are a very short-term trader, you maybe only be in a trade for a matter of minutes, a matter of hours. That price action that you're seeing, it doesn't move in a vacuum. There are drivers that are driving the price action, and you always have to be aware of the broader macro landscape. You've got the fundamental landscape, and of course now we have, sadly, the geopolitical landscape as well. This obviously makes markets much more unstable, even more uncertain than they are normally. They are always uncertain, but that uncertainty ramps up, and that is going to affect your risk and money management. In other words, your position. So whatever you have in your trading plan in terms of, well, I am only going to risk, say, 1%, for example, it may not be prudent to simply go to the max every time. And unless you are aware of all these currents that are swirling around, as it were, you can get very badly burned. And the purpose of this webinar is, yes, we are going to touch on the Forex, and yes, we're going to have a look at equities. I'm going to have a look at SPY. David is as well, but he's going to be focusing on Tesla, because I have here the earnings calendar, and we can see that the Tesla earnings are due literally at the close, which is at something like 1 minute past 9, and we will certainly be aware of it. And if you've been looking at Tesla today, you will see there's been some extraordinary price action there, but I will leave that to David to deal with. And we will also look at the Forex market, because from the VPO perspective, what I would like to look at is multiple timeframes. It's a topic that I started a little bit on my Twitter feed, and I kind of did a little roundup one day of the SPY, and I've actually used 4 charts, because time and timeframes is one of the 5 elements of VPA. And just to remind, it's obviously price action, volume, candles, candle patterns, or candles and patterns all come together, support and resistance, and time. And that's the time of the chart that you are looking at, but also multiple timeframes, which is why I've actually got the setup here that I have for SPY on TradingView. And the reason I want to introduce the Forex one is because the what we see on these charts, forget the ticker for the time being. We have the daily chart. What is the daily chart telling us? Are we, are we in a trend? Are we moving sideways? How much volatility is there? What is happening on that chart is going to influence the price, the type of price action you are going to face in the faster time frames. And if I just bring that one up, what we have here is obviously today's SPY, and what we're looking for is the structure of the chart, the geometry of the chart. What type of market are we likely to face? As I said, if it's in a trend, that's one type of market. If it's not in a trend, as it is here, it is essentially moving sideways. And I said yesterday on my Twitter feed that it's almost in what I call a holding pattern. It's neutral. It's not it is going up and it's going down, and within those bars there will be trading opportunities on the faster time frames. But as an investor, it's not going anywhere. And what the daily time frame then gives you, not only this information, but it then gives you those all important support and resistance levels that we really, really have to be aware of across the time frames that we have in our multiple time frame profile, because support and resistance levels on the slower time frames carry more weight. So you could be on a 5-minute chart and then suddenly the price action just seems to stop. And you look around, you think, well, what is happening? You look at the candles, you look at the pattern, you look at the volume going in, you maybe have your other indicators, you could have a moving average there, and you think, well, what's happening? But it's when you go up to another time frame, you will see that it has hit a significant level. There is a hierarchy to levels, and the ones on the slower time frames really do, they carry more weight. If they're very strong, if you have some of our quantum indicators, you will know on TradingView and on NinjaTrader and TradeStation, we have something called the accumulation and distribution indicator. These are levels that you can see on the chart here. You have these hatched lines, they're in blue and in red, but the important thing about them is that the thicker they are, what that means is that price level has been tested and it has held. Now you can say, well, what about in this situation here? You can see it went up and then down. These levels, they're levels and they're also zones. So, it's a case of, yes, it did go through, but it fell back. It came down again. It's tested it again. And that it gives you a visual representation of how tough that area, that zone, that resistance level is when the price does break, if the price does break through. And of course, it's going to take volume. And speaking of volume, certainly with equities and with the SPY, the ETF, is the nice thing about TradingView is you can just hover over a particular candle and it will give you what the current volume is. And what you really then need to do is you then need to go to maybe a site such as FinViz or Bar Chart and see whether that is the average for the day. Average volume is usually calculated over a 90-day period. I think Bar Chart gives you the option of having to see what the 20-day average is. And you can read that. So you can see what the volume is actually going in. Yesterday it was 75, which from memory is about average. So it gives you another aspect of volume. So as you know, we read volume in conjunction with what the spread of the candle is doing. Is there a wick to the top? Is there a wick to the bottom? And yesterday, yes, it was average volume, but we can see there was a wick to the top. It did go through this very strong level at 437, but it actually went straight into the 438 level and it came off there. So we know the session ended on a weak footing, if you like. So what is the expectation for the day after? It is only an expectation. Yes, it did come off. And what's happened today, it has actually fallen quite sharply, and it's gone straight back into that level again. And we won't know what the volume will be until the end of the session. We know what the range of the candle is at the moment, might not change significantly. Depending on how that ends, again, it may give us a clue for what is tomorrow. And if you want to see a little bit of VPA in action here, as I said, this is repeated across whatever you trade. You had this big up bar. This is actually the 200 MA. Don't have a lot of moving averages on my charts, but things like the 200 I do, also because when it coincides with 420, I think when it hit the 420, I said way back at the beginning of October, I said 420 is the level that has to hold, and in fact it's bounced off the 200. Big volume underneath it. It was actually a volatility candle. Price retraced into it, but look what happens subsequently. The volume kind of fades away as the price approached this significant level here. So we kind of know from a VPA perspective, it's going to have a bit of a struggle. So that's that little sort of example there, you will see repeated across all the time frames. But having the daily up in a multiple time frame matrix, which I have here, my own preference, certainly on TradingView, is I have the daily because I have all this important view of what I'm looking at. Then I have the hourly. And the reason I have the hourly is because I'm using our Camarilla indicator, and the levels that I have, not just from a support and resistance, a price-based support and resistance from the accumulation and distribution, is these levels that are given to me by our Camarilla indicator. They are good for the week. And so that gives me some, another target, if you like, for levels. And we can see here, what have we here? We have 437, and we have 437 up 437, which is just between these two levels here. So, and we have a sort of shooting star, hasn't been able to get through this level here, and down it's been going. Down at the 5-minute chart, this is the chart that I tend to use most often in whatever I'm trading, whether it's on TradingView or over on the Forex side on my MT4 account. What I have here is I actually have the VWAP. David will explain a little bit about some of the indicators that we are launching together with the stock program. This indicator down here, which is the VRSI, which is the volume relative strength indicator. Again, I'll get him to explain it. We also have variants of the VWAP, because the VWAP is what everyone uses. So you have to be aware of where it's sitting, what it's doing. And again, this is the price action that we've had this morning that, as I said, really follows on what we saw from yesterday's close and the kind of expectation that we had on the daily chart. I have the 5-minute chart, and I also have the 15-minute chart, because sometimes what happens is when the market is either quite volatile or it's not really moving very much, having these, it's sometimes you can toggle between the 5 and the 15. So if it's moving and you think, well, it's a little bit too noisy on the faster chart, just going up a time frame, it just takes away a little bit of that noise and the 15-minute. And of course, I actually have the Camarilla levels on the 15-minute. These levels are updated every day. So once the session closes, it'll be recalculated. There'll be fresh levels, and I will read them in conjunction with what the levels are on the hourly chart. If 4 time frames is a little bit too much for you, then at least go for 3, because I think 3 is very manageable. But if you can do the 4, or certainly just maybe have the daily on another monitor or something and just focus on, and if you really can't start with 3, is just too much, then just take 2. And I always say have the hour if you're on the faster time frames, and either the 5 or the 50. Before, I just want to also quickly run through some of the drivers that we have at the moment for the markets, particularly for equities. I just want to give you an example of what I mean by if I disappear slightly. David and I are actually recovering from COVID, and one of the things it's left us with is a really annoying cough, and you really don't want to hear it in your ear. So forgive me for that. I will come back to the SPY, and there's a couple of things I want to show you on the SPY as well. But I want to give you this example from the Forex market, and this was something that I placed up on my Facebook page, which is called Learn Forex Trading. As an example, what I actually said in my post is, as traders, we're always looking for, of course, trading opportunities, but we have to learn to recognize whether that trading opportunity is actually going to develop into something. And one of the ways you can establish that is by using multiple time frames. Now, here I've actually got 5. Well, I've actually got 4 in terms of time, but I've also got a Renko chart, which is not a time-based chart. But it's really, really useful for all sorts of other reasons. And the Renko that we've developed for MT4 is fantastic. There's also a Renko for Ninja and TradingView, but they work in a slightly different way. And the reason I highlighted this, there was a number of reasons. First of all, if we start over here with what we call the currency strength indicator, and obviously in you're trading a pair, and what you want is you want strong divergence. You want one going up strongly of the pair and the other going strongly in the opposite direction. And that gives you the divergence. And that translates into something like this, where you see a trend like this. This is, again, the daily chart. It actually, you have a very nice hammer candle. There's a reasonable amount of volume underneath it. And that was a really, really nice move in the New Zealand dollar. The New Zealand was actually going higher. And at that point, the dollar was having a bit of a pullback. This is also reflected in a currency strength indicator, because what these lines do, they represent the individual currencies. And this is what you don't want to see. When they're moving in the same direction, it tells you there's no divergence. Divergence is what we need in a currency pair. But what was also interesting is when we looked across our time frames, I have the hour, I have the 15, and I have the 5-minute, and the non-time based chart, which is the Renko. And what do we see? We see the price action between the R3, and this is the volume point of control. This is another one of our volume indicators. The volume point of control is, if you like, the fulcrum in the market. It's where there is no sense of clear direction. The buyers and sellers, you could say, a kind of imbalance in the terms of in agreement. They're happy to transact within usually a fairly narrow range. So if price is rotating around the volume point of control, unless you are going to take a very, very quick scalp, it's not going anywhere. It needs something to move it firmly in one direction or another. Now, that could be a piece of news. It could be the Fed. It could be any number of factors that are relevant to the New Zealand dollar. What makes it even more clear that this isn't going anywhere is when we look at the 15-minute chart, it's also at the volume point of control. And then when we look at the 5-minute chart, where is this price action? It's not going anywhere. Yes, it goes up a bit, it comes down a bit. I mean, volume is, you might have a little VPA thing. You can see there, you've got 2 candles. You've got that goes down, the volume goes down, so it's not going to go any further. And it's at the S4. The 3rd level and the 4th level of the Camarilla are probably the most important, and it goes straight back into the volume point of control, keeps on going sideways, nothing is happening. When we move over to the Renko chart, that really crystallizes this picture for you. What do we have? Well, we've had a little bit of a trend lower. We can see that. We can see that fall there. It actually came off the R1, didn't quite get to the R4. Then it attempted to rise. Very, very we call that a choppy move higher, lots of pullbacks. It comes down again. It actually then hits the S4, as we can see here. And this is reflecting this, and it's reflecting that, and it's reflecting that. On the daily, yes, we have this down candle, but that has happened in the previous session. So this is an illustration, if you like, of really understanding through multiple time frames what kind of market condition from a price action perspective you are going to face. If you're only on one chart, and I know a lot of traders are, yes, you can see that is a congestion, but looking at it, as I said, if you look at the 50, the hourly chart and even the daily chart, nothing is going to stay in this state for long. Markets cannot stay in congestion forever. It's as if nothing's moving. Something will happen. The only thing we would say is go back to Wyckoff's second law of cause and effect. Is the longer this cause, this congestion, this consolidation, this sideways movement, the bigger the effect. And what we can see, that was the 11th of October. If we actually, you can see the result of that, and this is the Dixie, this is the dollar. Doesn't matter whether you trade forex, as I said, whatever. Always be aware of what the dollar is doing, as well as the what's happening in the bonds. Let me just find out, because I thought this was really, really interesting. New Zealand dollar, Kiwi dollar. There we are. Right. I think the best way to look, in fact, let's look at the daily chart, because we can see this was the candle that we were looking at on the daily. And with hindsight, you could say, oh, great. This was this move higher. This was on a really nice hammer candle. It's actually at the volume point the volume point of control on the daily chart, but obviously the range is much wider. We've had some really big candles for the New Zealand dollar over just before the 11th of October as it was going up. But you have to remember, within one of those, in each individual candle, that's 3 separate sessions. So that would have been down in Asia, and then coming back again in Europe and London, and ending up there in the US session, and then it carries on through at some point in Asia. So that represents 3 different sessions, and we always say in forex, you really have to treat each session as almost a new day. I know forex is 24/7, but it's there are 3 very distinct sessions. So here we were on the 11th. There we are. We could see that. You could say, is that not quite a 2-bar reversal? We've got the R6 up here. That's fine. What actually happened at the time when it was in that congestion? Could you have said, well, that is going to be a reversal. Look at that lovely move lower. That's it. You can't. You just have to be patient, and that's one of the things you have to be aware of, is that when you have these heavy congestions across the time frames, you have to be patient, because the market will break, and the price action and the volume will confirm, and your levels will tell you where the price is likely to be going. So that's what I wanted to say in terms of multiple time frames. To return to the SPY, what do we have to be aware of in terms of other markets? Well, clearly at the moment, we have to be aware of what the bond market is doing, what the Fed is doing. I think this week we've had, somebody broke down 17 different Fed members, or at least they're going to be speaking a combination of 17 times. And I think Powell is up tomorrow as well. So you really, really have to be clearly their message about inflation, interest rates, etc., etc. They keep saying one thing. They kind of speak out of both sides of their mouth. On the one hand, they're saying, yes, we're going to be firm, and yes, we're going to keep to raising rates until inflation under control. And then the market kind of somebody else says something else and interprets it as, well, actually, it's a bit of a dovish statement. And that is going to be reflected in the price action. I was going to do a whole thing about bonds, but I want to pass over to David because bonds are extremely important at the moment. The bond market is always important, but it is more important than it has been for a long while. All I would say to you, I've asked a question on Twitter, is can you give me the sort of, elevator pitch about the bond market? Yields and the price of bonds move inversely. So as yields go up, the price of bonds goes down, and vice versa. Yields are going up. They're going up across all the maturities. We still have an inverted yield curve. That means the ones at the long end are slightly lower than the ones at the short end. That always precedes a recession. Takes a long time. It could be 18 months, 2 years, but that's where we are in terms of what the yield curve is doing at the moment. What are the ones to watch? The one to watch is the 10-year in particular, because that is the benchmark for all debt. And by all debt, I mean the debt for our credit cards, for our mortgages, but also the debts that companies have. So if you are trading stocks or you're thinking of investing in stocks, how a company deals with its debts in terms of managing that debt. Is it had too much debt? And if yields keep going up, when they come to refinance those debts, that's going to be a problem. A solid company is one that uses debt judiciously and it manages it. It's not too much, a bit like Goldilocks, not too much, not too little. So from an investment perspective, that's why you have to look at bonds. What also is with bonds at the moment is the increasing yields also reflects, you may remember, the US was given a bit of a downgrade, and basically a bond is you want to borrow money you want people to lend it to you because you need the money. Now, if you are going to be you're going to lend somebody money, you want a return, and that return is going to be based on how long you're going to lend that money for, but also the risk on it. Now, the US, the UK has not defaulted, and then the US has defaulted. So you're going to be pretty sure about your money, but nothing is risk-free. But what has been happening because of the deficit, because of all sorts of other reasons, the yield that has to be offered, the interest that has to be paid has been going up and up. And it comes to a point that, well, at what point is that yield going to cap out, going to top out, as it were? So it's a bit of a delicate balance. Now, what happens when yields go down, and they go down very fast, is that can happen when we have, I wouldn't say Armageddon, but things get really, really sticky, and investors and traders, they go into safe havens. Treasuries are still considered a safe haven. They're not completely risk-free. At the moment, they are giving a high yield, partly because the US government is having to pay more for people to buy them. At the short end of the maturities, that's on the bills, that's on the 3 months and the month, really going up almost up to the 5-year bond. You can get over 5%, and if you think about it, I can get 5% for 3 months with practically no risk. I know I'm going to get my money back, and I know I'm going to get 5%. That's also drawing money away from equities, and you get this inflection point between equities and bonds, and there is a flip. And that flip, the reason for that flip may not just be one reason. It could be a whole multitude of reasons. It could be a geopolitical one. It could be as I said, I'm not going to go into it in great detail. It's all covered in massive details in our stock program, but you just have to be aware of what the bond market is saying. What the bond market also does is, if a government wants to fund something, for example, a war, the bond market will set the terms because it has to borrow the money. It's really all about money and the cost of that money. David can fill it out a little bit more. He'll have his opinions on the bond market as well. And when the bond market becomes volatile, and we know it's volatile through what we call the MOVE, MOVE, which is an index, we know that they're very, very sticky. Bond markets should be very boring. They have to be, they should be boring, and they should be, they happily go off in the background. Money, the debt is created. There's good debt, bad debt, but it's for development, for moving things forward. When the bond market gets twitchy, gets very nervous, it will then punish whoever it is that is involved. That could be a government, it could be a company, etc., etc. Right. To go back to the SPY, there is one other element that we have to be aware of with the SPY, the S&P 500, the NASDAQ, the Qs, whatever index you are thinking of trading or investing in. And that is, these are what are called market cap. In other words, the biggest companies by market cap in these index carry the most weight. So therefore, when they move in tandem, they will contribute to the biggest move in the overall index. Now, you may already be aware of that. You may have heard of a term called the Magnificent Seven. They are basically 7 stocks that make up almost 30% of the S&P 500, and by definition, by extension, the SPY. And the 7 companies, and what I've actually done is, you can do this on TradingView. I've actually created my own index because, to be honest, these 7 companies are what are moving the S&P 500 and the SPY. And it's, as we can see, it's Tesla, Apple, 3, Nvidia, Amazon, Meta, Microsoft, and Google. I mean, you could go up to 10, but their weightings are, the 8th, 9th, 10th companies are minute. And this has just been invaluable for me because it saves looking at the individual charts. So what I have here is, what are these 7 characters doing? Are they making a half decent move? What's the volume that's going into these 7 companies? Are they propping things up? So when things are not going so well in terms of market breadth, which is not fantastic at the moment for the other 493 companies, if these 7 are doing well, it holds up the market, it buoys it up. What are we actually seeing at the moment? We're actually seeing them moving sideways. But what's more interesting is, if we look at the monthly chart, is we have the potential, what I call this double top. If this market is going to go higher, then certainly from the S&P 500, set the Qs aside for the time, for the NASDAQ at the moment. If it goes through this level here, these 7 stocks, because by virtue of how the index is structured, then, who knows where it's going to go next. But if that double top actually sticks and stays, then it's a question of, well, how low is it going to go? And then we go back and have a look at the weekly chart. Then we have a look at the individual charts for the SPY and the S&P 500, and that is the double top. Here we are, and this is obviously the price action between those 2 points on the monthly chart. And you can see there's been some tremendous price action. This is January. If we look under here, we've got a level here off the VPOC. You had it coming down, and you have this little sort of tiny hammer under here with a reasonable amount of volume underneath it, and then gradually this is the move that we have seen this year in these 7 stocks, which have driven the indices, or certainly the S&P 500, higher. Going back to our multiple timeframes, I'm going to move over to David in a second. What are we seeing at the moment? Let's have a look. Let's go back to the 5-minute chart. Let's see. In fact, I'm going to go over and look at the 15 because sometimes you can't actually always appreciate the VPA lessons and the thingy. What do we have here? Okay, we started off the usual sort of volatility. We have this this resistance here that we have here at 435, pretty close to that level that we saw on the daily chart. And as I said, we had the yesterday's candle was an up candle, but it had a wick to the top of the candle, above average volume as well. If that had been much higher volume with a big wick to the top, then possibly you could have expected the price to go down even lower. This is what you would normally expect at the physical open. This is obviously the pre-market, and not much sort of going on there. And what do we have here? A lot of wicks at the top and the bottom, wicked on this doji candle. Doji candles are good two-way price action. Certainly if you're on the very fast time frames and you could take a trade, that's fine. You see the price volume is going up, and then you have this very deep wick candle here, and that really kind of confirms the weakness that is coming in. But it's very scrappy, it's very messy. You have wicks, and the price keeps trying to rise and keeps beating back. And yes, it is a trend lower in the terms of you've got lower highs, you've kind of got lower lows as well. And this is another thing we say about trends. Trends they're not always nice and smooth. This is a volatile trend. It's a scrappy trend. You may not want to trade in this kind of environment. And in a way, that's great to see with kind of hindsight. What's almost better is this kind of move, this kind of trend, a much smoother trend. And maybe you have to be patient and wait for those opportunities. Stay out when you have these wicked candles, because while the price is forming, put yourself in at this point in time, as it were, and it's just a lot of whipsaw and a lot of chop, and you think, no, I really don't want to see that. I really prefer this kind of much smoother price action. The price is falling, you've got a decent amount of volume on it, then you look at your support and resistance. Again, it stopped bang on the S6, and we're coming up to, it's going to be the close soon. But this type of price action we have here, we can see at other times of the session. You don't have to wait for it at the end. Sometimes you can see it in the middle of the the session. Oh, by the way, this sudden, I've had on Twitter, I said, well, what suddenly happened? Why is that suddenly shot up? And I've seen all sorts of reasons. Oh, it's because the dollar, all sorts of ridiculous reasons to do with the bonds. Yeah, there was a bond auction today, but actually what it was, it goes back to those pesky Fed speakers again. It was an interpretation that things aren't, the interest rates, they're not going to, they've kind of calmed down. The neutral rate is, they're there, and etc. It's what they say, and you can't legislate for it. You just have to be aware that these characters are going to be speaking. Have them on your news feed, and if you're in this position here, and suddenly that happens, and don't forget, it's a great opportunity for manipulation. So that's just something you have to be aware of. Have a good news feed, and if something untoward happens, just get out. And again, what happens? The downward trend is actually restored. But again, we have the volatility candles. You've got rising volume. This is a nice little signal, because you think, oh, great, it's actually going to go up. But in fact, it's within the spread of the candle. Within volatility candles, this is what you normally get. And it's at the volume point of control. Again, wait, and you've actually got a really nice break lower. Not a lot, but it's smooth, and as I said, that's what we want to see, particularly when we then read it in conjunction with what is happening on the other time frames. Right, I'm actually going to pass to David now. If you've got any questions, please just put them into the chat box. We're happy to answer them on anything I've said and anything David says. But let me pass over to him, because I think he's got lots of things to say as well.